US markets are absorbing yesterday's gloomy data, which proved a slowdown in the United States manufacturing sector. The US economy seems to have slipped into recession. Meanwhile, both the US dollar and futures on the US stock indexes are going down. Sell-offs on Wall Street look odd because the stock market should be delighted, as the Fed is likely to complete its cycle of rate hikes soon. In the light of the recent economic data, it seems a realistic scenario. US stock markets made a downward correction on Wednesday, and the major indexes traded lower. The indexes could resume their rally because of growing expectations for the pause in the Fed's monetary tightening. This scenario will depend on a fresh employment data and the market response on it. Today, ADP payroll processor released its employment report. It prefaces the official NONFARM payrolls, which are due on a Friday and which will set markets in motion. The US private sector created 145,000 jobs in March, less than the expected increase of 200,000 and down from the upwardly revised 261,000 jobs in February. The red-hot data signals that the economy is cooling down. Employers give up after a year of robust hiring. Besides, wage growth inched down after a plateau for 3 months. The ISM non-manufacturing PMI for March is on a tap later today. If the reading is below the consensus, it will be an unpleasant surprise, thus adding fresh evidence of a looming recession in the US economy. Such prospects could assure the Federal Reserve to hit a pause button on a monetary tightening. Wall Street is on edge today. ADP employment report followed a weak JOLTS job openings report and downbeat factory orders released on Tuesday. With obscure economic prospects, the S&P 500 halted a winning streak it developed for a few sessions. The fact that the US Fed could withdraw its aggressive monetary policy in May is likely to boost the appetite for risk. Investors are anticipating the end of the cycle of rate hikes. However, the market voices concern that the US Fed could halt the hawkish policy ahead of the schedule when the struggle against inflation is not over yet. The US could encounter another problem, stagflation, and when the economy shrinks while inflation continues to accelerate. At present, the Fed Watch tool indicates a 54.6% chance that the rate hikes will be suspended in May, and the rest of the market participants are betting on a rate hike by 25 basis points. A month ago, nobody predicted that the Fed could begin loosening its monetary policy. The likelihood of a softer monetary policy assures investors to keep long positions on shares. Futures on the S&P 500 were hovering at above 4,100 points, but could not settle above that high. The bulls failed to protect this level. If they manage to win it again, the door will be open for a rebound to 4,200 points, a one-year high. The Nasdaq remains above the key level of 12,900 points. Recently, investors taken no notice of any information which contradicts their viewpoint and give priority to the facts which confirm their opinion. Thus, new highs for Nasdaq are around the corner. The US dollar has been striving to regain its footing for a second session. It will hardly meet the challenge amid expectations for the Fed status quo at the policy meeting in May, and the index was hovering at around 102 points before the economic data was released. The overall market sentiment and the WIX index for the banking sector clearly indicate that the US dollar is losing its luster. The fundamentals push the greenback down. The technical picture signals that the US dollar index could settle below 102 points, with the target level for short positions at 100 points. The previous target of 101 points has been already secured by the dollar bears. And today the US dollar index opened in the red and then became on the defensive at 101 points. Traders are alert to the report of a crucial importance, the US NONFARM payrolls, which are due on a Friday. The main concern is a strong employment that could give the US Fed leverage to revive the previous hawkish stance. Judging by market moves, traders are betting on a surprise of a big data. The USD card pay is creeping down after some consolidation. The instrument is trading quietly. On a Monday, the pair went steeply down. In the early American trade, the USD card pair inched down amid the US dollar's weakness across the board, driven by a new portion of data on the labor market. Having dipped to 1.3400 earlier today, the pair rebounded to 1.3550. Despite the overall greenback's weakness, the USD card pair reversed its trajectory upward. The commodity-sensitive loonie did not find beats amid a decline in oil prices. WTI jumped to the highest level in 2 months at $82 a barrel yesterday, and today the US benchmark is trading at about $80. Brent crude is also trading lower, but the buyers are struggling for the level of $85. The next target is seen at $86. The Canadian dollar could win favor with investors. April is commonly a beneficial month for the loonie. A recent sell-off of the loonie could happen in the wake of the bank crisis in the United States, but it was not justified. Canada's banking sector is a different story. Its financial system is not so fragmented, and banks do not see such strong volatility in deposits as in the United States. Lately, Bitcoin is trading sideways with a muted volatility. The token is trading at about $28,570 during the New York session with a downward bias. Bitcoin's liquidity fell to the lowest level in 10 months due to failures of popular crypto exchanges and a crackdown of US monetary authorities on the crypto industry. Meanwhile, crypto assets, especially Bitcoin, are expected to arouse interest among investors due to worsening macroeconomic conditions in the United States. The flagship crypto has settled at around 28,000, and the short-term outlook is cautious because no high-impact news is expected in the coming days. The equal balance between the bulls and the bears keeps Bitcoin in a trading range. Neither buyers nor sellers can take the lead. Currently, the crypto market is thin with a minor trading volume. It means that investors are revising their sentiment. It looks like a lull before the storm. Good luck in your trading and see you online soon.